All right, so if you probably came to this video because you saw my other video on USDA. And now to clarify, when I released that other video, I did not expect it to do what it did. I have a lot of people reaching out trying to get USDA loans, and honestly, I think a lot of you didn't watch my video all the way through. I talk about how hard it is to really get them, what it really looks like to get a USDA, and how low the income limits and the debt to income ratio really are to where you really can't afford a whole lot of a house. So today, I want to talk you through why USDA versus down payment assistance is such a big conversation that I have with my clients and which one usually works better. So I'm Jake from Home Loans, and today we're going to dive into a bit of background on these topics. Now, in 2024, around 10,000 total Californians, and specifically Californians, used down payment assistance programs, whereas only about a third of that, only about 3,500 or so, actually used a USDA program. Now, that's not saying USDA loans aren't great loans, but most options here are situational, and you need to do what's actually going to make sense for you with the purchase price that you're looking at, as well as what you can actually afford. So while USDA loans offer 0% down, it's hard to qualify at a home price you actually might want. Whereas FHA can most likely get you that home price, but a lot of people don't realize the benefit and how down payment assistance actually works. So today we're going to go through the difference between USDA loans or FHA plus down payment assistance. And we're going to see why so many more people use the down payment assistance loans than USDA. Now, as I mentioned in other videos, USDA loans have a $0 down payment, which makes them awesome. So nothing out of pocket for the down payment. Obviously, there's still closing costs you got to deal with, but they are also specifically designed for some rural or less suburban areas. So want to know if property qualifies, you can always look up on the map down below. And there's a good chance if you're outside of any major metropolitan area, you do qualify. Now, obviously, USDA has income limits, but that's usually not the issue. The issue is the debt to income ratio. Now, where FHA, the debt to income ratio is going to be sitting around a 50 to even a 55% if you have good credit, which is pretty high. A debt to income ratio on a USDA loan comes in around 30%. Now, if we look at this actually on paper, just for example, let's say you have no other debt. You're just looking to qualify for a house. You don't have a car payment or a credit card or anything else. If you make $5,000 a month, half of that, so 50%, is what you'd qualify for in a monthly payment with an FHA loan. That's $2,500 a month could be your mortgage payment. With a USDA loan, if you make $5,000 a month and you can only qualify at 30%, you're looking around $1,500 a month. And a $1,500 mortgage payment doesn't really exist on most home prices, at least not in California. Now, if you're not in California, just disregard this video. I'm talking specifically to Californians on this one. Now, this brings us to why aren't USDA loans more popular? First off, the restrictions. Second off, the income limits. Third, the DTI. Especially in California, the debt to income ratio is so hard to qualify under that not many people can actually afford the home they even want to consider at what they can technically qualify for under a USDA loan. Now, for most people I talk to, about 95% of everybody that comes through the door looking for a USDA loan, we end up getting into a different program. And not specifically in California, the one that I use the most is CalHFA's Down Payment Assistance. Now, you can use this conventional or FHA, but when USDA doesn't actually fit your situation, or say you're like us and I live in Sacramento, anywhere around here, even if you go out to the foothills where USDA loans qualify, you're not going to find almost any homes for a price you want that you could actually move into. Now, let's look at the alternative of an FHA loan with the down payment assistance. First off, FHA loans require a 3.5% down payment. They have super flexible income as well as underwriting guidelines, and they're nationwide. So it doesn't really matter where you live. You can be in the middle of Sacramento or way out in the middle of nowhere. It doesn't matter. FHA loans could qualify. Now, they do require mortgage insurance, which is going to be a bit higher monthly than what your USDA mortgage insurance would be. But because it's a government-backed loan, it's also going to have a lower rate similar to USDA's rate. Now, here's the kicker. Down payment assistance. So I'm specifically talking about one program. There's over 200 different down payment assistance programs in California available at any time. But this is the one I work with the most. And personally, out of all the ones that I've seen and used, this has been the best bang for your buck, no matter where you're at in California. It's not regional. It's not based on city or county. It's all of California, and that's why I wanted to talk about it. So this program is called CalHFA, so California's Housing Finance Authority. What it does is it covers that minimum down payment for you. So on an FHA loan, the minimum down payment is 3.5%. Basically, you take out a second loan through CalHFA. They give you the money to pay that down payment assistance. Now you have two loans. You have one for the main house with the 96.5% of the loan, and the other 3.5% you borrow from CalHFA. So you're totaling 100% of the home value. Now, the reason I love these loans, and specifically the FHA CalHFA loan, is because FHA allows for up to a 6% seller's credit on their loan products, which means even after the 2% fee there is to use it from the lender for CalHFA's program, you can get all of your closing costs covered if you structure your offer right. So in the last few years, I have had multiple buyers move in for $0 out of pocket. Now, what's cool about CalHFA is this is not a second loan. That 3.5% you're borrowing is not at a normal interest rate. It's actually at a 1% simple interest rate, which means if you borrow, let's say $12,000 for the down payment, then you're paying a total of $120 per year in interest, not per month, per year. That is very, very little interest. And that can be actually paid for when you refinance or sell the house. It'll pay off that second loan. So why do I make this video? Honestly, because you have been awesome. And all these people have been reaching out to me about my last USDA video without watching the whole thing through, thinking they're going to qualify just off USDA because it's zero down. And that's not how it's going to work. So I made this video to show you that if you're watching these videos on USDA with the 0% down is not your only option to get into a home. And I'm linking below my other CalHFA down payment assistance videos because I think you should go check them out. Because honestly, I go a lot more in depth for you to understand exactly how the program works. These are awesome programs if you use them correctly. And mainly being, if you have a decent monthly income, but you don't have a ton of cash up front, those are the best people to use these loans, is people that can afford the monthly payments, but don't have a ton of capital up front. You know, maybe you've been paying off debt, maybe you've been working on some other things, but you still want to buy that house. So if you're looking to buy a home and you don't know if you're going to work for USDA, reach out. I'm happy to still go through it with you and see if we can qualify you for USDA. But if not, these CalHFA and down payment assistance loans may work better for your situation, just like they do for a lot of Californians out there. So my stuff's linked below. Reach out. I'd love to chat with you. And if you haven't, go find me on Instagram and see my other stuff that I'm putting out. I'll talk to you soon.